Hello and welcome to our webinar, The Benefits of a Passive Investment Strategy, presented by Next Generation and Spartan Investors. Before we get into the conversation, I wanted to briefly go over some housekeeping items, tell you a bit about Next Generation, and then we'll introduce our speakers. First and foremost, for our housekeeping items, I wanted to let everybody know that this webinar has been pre-recorded. So if you have any questions regarding the webinar or its content, please use one of the functions on the landing page below to submit them to Next Generation or Spartan Investors for follow-up. And now to tell you a bit about Next Generation. Next Generation is a custodian and administrator for self-directed retirement plans. So these plans are much like the plans that you would find at any brokerage like Fidelity or Charles Schwab. The only difference between them being the types of investments that can be held within them. So instead of investing in stocks, bonds, and other publicly traded assets, self-directed IRAs give investors the opportunity to hold alternative investments within a tax-advantaged retirement vehicle. These accounts can provide a hedge against stock market volatility. They allow investors to diversify their retirement portfolios, and they give individuals added control over their investment returns by investing in what they know best. Next Generation is a women-owned business, was established in 2004, and there's two main arms of our business. The first is our administrative arm and headquarters, which is Next Generation Services, located in Roseland, New Jersey. Next Generation Services handles all of the back office administration, record keeping, mandatory tax reporting, customer service, and transaction support for all of our client accounts. And then Next Generation Trust Company, which is chartered and located in Sioux Falls, South Dakota, is a licensed chartered trust company which serves as custodian for all of our accounts assets. So now to give you our very necessary disclaimer on what we don't do. Next Generation is not a bank or fiduciary, so we do not provide any financial, tax, or legal advice. And Next Generation does not endorse, recommend, or review the merits of any investment. Therefore, any information provided on this webinar is for educational purposes only. So for this conversation, we have our co-host, Ted Green. Ted, give a wave. The Investor Relations Manager at Spartan Investors. Alongside him, we have our very own Scott Ritchie, who is Next Generation's Business Development Specialist. And I'll allow them to introduce themselves so you can get to know them a little bit better. So let's start with Ted. Ted, why don't you tell us a little bit about yourself?
Hi, folks. It's nice to be with you today. I represent Spartan Investment Group, and on the web, we can be found at spartan-investors.com. I'm in my mid-50s. I spent about 24 years as an investment advisor and portfolio manager. Most of that was with Merrill Lynch. I finished as a chief compliance officer as well as producing investment advisor, and then sold the company to Yield Street and then landed here at Spartan Investment Group. In my role here at Spartan is to convey to investors the risks and characteristics of the private securities that we issue.
Thank you, Ted. And now we'll go on to Scott. So Scott, tell us a bit about yourself.
Well, thank you, Erica. Yes, my name is Scott Ritchie. I am a business development specialist here at Next Generation. I've been at Next Generation just over 3 years. Prior to coming to Next Generation, I worked in the traditional marketplace. I was a counsel agent with New York Life, where I obtained my LUTCF designation. And I also worked as a retirement plan specialist for both 401ks and 403bs.
Thank you, Scott. So now we'll get into the conversation. So Scott, back to you to get things rolling, and I'll see you all at the end.
Great. Thank you so much, Erica. Well, Ted, thank you so much for joining us. We had a lot of preliminary conversation before this webinar. And what struck me is when you were speaking about the economy. And if you could elaborate a little bit, give me an idea of where you think the economy is going. Specifically, where's the Fed leading us? There's been a lot of rate hikes, there's talk of inflation, et cetera. And I guess for a lot of the investors out there, they just want to try to make heads or tails of it.
That's a very relevant question, and thanks for having me, Scott. By way of background, at Spartan-investors.com, I do a bit of writing, try to get out 2 articles per month by way of, current events and how to synthesize those events and apply them to your investment philosophy. By way of the Federal Reserve, my concern, and of course, we're not in the business of giving tax, legal, or investment advice. My concern is that it's quite possible the Fed may be overdoing things by way of raising the federal funds rate. And just a quick definition, the federal funds rate is simply the overnight interest rate that banks charge each other for cash deposits. Of course, they've got a tier ratio that they have to meet when making loans, so they have to have cash on hand to fill those deposits. So with that being said, longtime chief North American economist David Rosenberg, this is going back to the early 1990s with Merrill Lynch, David frequently reminded us that it takes 12 to 18 months for the economy to feel the full effect of a Fed rate increase. Now, this is now mid-November, late November of 2022. And as we saw about 2 weeks ago, the core CPI, Consumer Price Index, the core CPI is X food and energy. And month over month, from October to November, we saw 0 by way of an inflation uptick. Again, that's the core, which is X food and energy. So my goodness, here the Fed has had 4 sequential 3/4 point federal funds rate increases. And my experience has been the chief North American economist for Merrill Lynch telling me it takes 18 months for that to fully be felt in the economy. So I'm no economist. I just have a lot of scar tissue from being age 53 and having been an investment advisor through a couple of rough patches. So my concern is maybe we're getting out over the end of our skis and the Fed may be overdoing it. An interesting statistic that I might suggest folks ponder as a tag-along thought. Generally speaking, in major market bottoms, the yield on the 10-year government bond matches the yield on the S&P 500, pick your favorite ETF, be it Vanguard or whomever. But generally speaking, the yield on the ETF for the S&P 500 has in the past matched the yield on the 10-year government bond. Now, by no means is that investment advice from the perspective that, things change. That may not be the case this go around. But from a broad level, my concern is the Fed may be overdoing it just a little bit, and we may be out over the end of our skis.
That's a great synopsis of what's going on. And I guess that'll lead into with all this talk of, the interest rates, inflation, it's got to have some sort of impact on investors and what direction they want to go into. So I was wondering if you can give me a little bit of an introduction to the passive investment market to kind of steer people away from, I guess, the traditional investment.
Yeah. So, and that's an interesting perspective. When we come from periods of excess where the Fed has artificially lowered interest rates, that can oftentimes, not always, but that can oftentimes plural, lead to periods of excess. There's a new term that has come around in the last 5 or 7 years, and that is FOMO, which is fear of missing out. You see your neighbor who may have levered their home to borrow funds to buy a single family residence and rent it out. And maybe they've done that 2 or 3 times. And they're, for all of us, it's human nature. There's that FOMO of, my goodness, increased risk. There's a direct correlation to an increased net worth. So, the fear is maybe there's a period of excess that has developed over the last 10 years. And I think candidly, the Fed is decidedly trying to slow the economy to get to that 2% inflationary number to take some of the heat out of the economy. With that being said, the world of private investments, not specific to Spartan Investment Group, but the world of private investments, I think can be used by investors from the following perspective. In periods of excess, where it's risk on, you're in the left-hand lane proverbially with the gas pedal all the way to the floor. The tech stocks are raging, the Bitcoins are raging, the market's raging. That's a risk-on environment, and investors have a tendency to invest to make as much as they can, regardless of age, relative closeness to retirement. There's that FOMO. It's there. It's palpable. I would view investors, and I think that investors have the following opportunity by way of private investments. They can orchestrate or design their portfolio and invest to get what they need. My perspective, this is not necessarily the right perspective, but my perspective is architect a portfolio that throws off cash or gives you cash flow to meet a certain threshold or a certain budgetary need. Back in the days of my time on Wall Street, an age-old rule of thumb was take your age, put a % sign behind it, and it's the percentage of your investment portfolio that should be allocated to the bond market. Now, that rule has kind of broken the last 10 years because the Fed's so active pushing bond values up, that's compressed yields lower until the last year. So to a degree, that rule is no longer relevant, but you can flip that a little bit and architect the following posture or manufacture the following posture. The closer you get to retirement, the more you create income in your portfolio from a basket or a variety of private investments that, working in concert, give you the cash flow that you need. And we'll come back to that in a moment later in this conversation. But I think the passive investment market, not specific to Spartan, but specific to the investor, it's a tool in the tool chest that can be brought out and used. And a way to evaluate success is whether or not the combination, and I'm speaking to best practices here, whether or not the combination of a variety of private investments take the investor to not making as much as they can, but investing to get what they need. And so they come to the table with a predisposed notion of, okay, my definition of success looks like da-da. And then they go out and they implement that definition of success. So Scott, I've rambled a little bit, but there's a lot of legitimacy to that, I believe.
Well, I mean, listen, the information is great. And I guess you said you rambled, but I'd actually like you to expand a little on why the passive investment market might be a good alternative to traditional investments.
Yeah. So a characteristic to what many sponsors do, and I'm going to leave Spartan out of this, a characteristic to what many sponsors do is they drive the net income at the asset. They drive it higher. Now, here comes a $20 term, value add. So now specific to Spartan, a characteristic of our investments that we shoot for or target, I can't guarantee by any stretch, but a characteristic that we target is incremental net operating income. If the asset throws off incremental net operating income, because Spartan, as a syndicator of self-storage, if we find a market that is underserved and we can construct additional self-storage units that are subsequently leased up, that means the asset is going to throw off more cash flow than when we bought it. Yes, lending rates are higher. That's a bit problematic. Yes, there are some markets that may be underserved and need incremental self-storage due to migration patterns and employment patterns. Suffice it to say, if you can gain control of an asset where the market needs more of what that asset has, for us, that's self-storage. Other sponsors are involved in multifamily. That's very appropriate. But if you can get an asset that's throwing off incremental cash flow, that protects the value of the asset even amidst rising interest rates. So you're gaining the cash flow that your personal financial plan or your personal financial goals articulate, that's your definition of success. So you can start to put together the puzzle pieces by way of, the characteristics that manifest the risk profile that you have for yourself, excuse me, gaining the cash flow that you're trying to achieve. And it also protects you to a degree because you've got that incremental cash flow coming off of the asset, protecting its value in interest rate increasing, in an interest rate environment that is increasing.
Okay, so in what way can an investor find out about the benefit of a passive investment strategy?
So I think a couple of there's a couple. It's a good question, actually. I think there's a couple of aspects to the answer there. First of all, the investor needs to identify what does success for them look like. And we talked for a moment about the fear of missing out, and maybe I should be taking more risk because it's working out for my neighbor. And that works great while it's risk on. That works horribly when it's risk off. So anyway, you need to identify what it is that success looks like for the investor. And then the investor needs to identify, well, okay, what are the risks and what are the characteristics of these private investments that I'm considering? How do they perform when it's risk on or when interest rates made available by the Fed are accommodative, as well as how do they perform when it's risk off and there's an increasing interest rate environment, which causes investors to be a little bit more cautious with their cash. So you need to understand the characteristics of the investment. And a great way to do that is by way of self-education, either at meetup groups. There are a variety of conferences around the country that you can go to. It probably costs $500 to get into one of these events. But you can hear from a variety of investors. You can also listen to the sponsors as they talk about their securities that they're issuing. But then also, once you've armed yourself with this information, have a specific conversation with an investor relations team member. My day is filled with conversations about understanding the risks and the characteristics of our securities and conveying those principles and those concepts to the investors that partner with Spartan Investment Group. So, get a hold of a knucklehead like me and just talk through it. This is what I'm trying to do. What do you think?
So there's a lot of resources out there, basically, is what you're saying, to get some information.
There's a lot of resources out there. Yeah.
Okay, so you had mentioned syndication and previously, and I just wanted to come back to that. How does the real estate syndication fit into the passive investment strategy?
So I think investors would be well served to not only get their mind around that question, but let's take it from even the top of the funnel. By way of all passive investments, how do those fit into my life? And I think best practices are in small increments spread across a variety of different asset classes with varying maturity schedules, varying risk profiles. One of the tools that Spartan Investment Group makes available on our website is a free Excel file that I designed with the intent to help an investor map out their entire portfolio. So much like at Merrill Lynch, I keep falling back to, the old soft shoe that I'm so familiar with, but the brokerage statements at Fidelity, Schwab, Merrill, Vanguard, all of them, they start with cash, they go to bonds, they go to stocks, they show you your basis, the date, market value, yield, et cetera. And it's all rolled up. So you've got a feel. And there's 10 sectors in the stock market: energy, financials, consumer staples, durables, yada, yada, yada. I think investors really benefit by having that same map of their private investment portfolio. And so on our website, we've got an Excel file that's got a couple of macros in it. and it helps the investor map out their current holdings based on asset class. Is an investor over concentrated in multifamily? Are they over concentrated in self-storage? So identify the holes in your portfolio. Here's one. Identify that, and this is not a CFP, pay somebody $5,000 for a financial plan. This is a Saturday morning with a cup of coffee with your spouse or your partner, architecting. In 5 years, I'm 53, in 5 years, maybe I want to be able to pull the plug out of the wall and not work. Now, I happen to really enjoy what I do because I'm pretty social and I like our investors. But with that being said, everybody would like to be able to know when they've got more independence, let's call it. So mapping out at what point would you like to be able to take more control of your time, and what needs to happen between now and then? And you can't get all of that done in 1 year. If somebody has a $2 million 401k plan and they leave their employer, which makes that asset now portable, the investor needs to be thinking about, well, okay, do I love the stock market and the volatility therein? Or are there other resources? Now, let me tell you this for sure, Scott. The broker dealers, the registered investment advisors, they're very aware of the amount of time it takes a compliance officer to get their arms around the risks and the characteristics of that asset. And they're very aware, if a sponsor is raising $30 million or $50 million, that broker dealer, that registered investment advisor, they're not going to give that investment the time of day because they can't expose all of their investors to it and have all of their investors invest $25,000 or $150,000 or whatever. So in other words, don't look to your broker dealer for these types of securities. Yes, the investor needs to do the due diligence, and there's firms like Veravest where they do due diligence. And you can find sponsors that have had the books for the securities scrubbed and evaluated. But the point is, the individual investor can take it upon themselves to manufacture that portfolio that to some degree is paying them current income, to some degree has the likelihood of growing the cash flow. Anyway, I'm getting a little long in the tooth here. Designing your definition of success, road mapping how you get to that definition of success and the amount of time and the percentage of your assets you want to move from this asset class to that asset class in accordance with your preference or aversion for risk. All of these things are very appropriate conversations to have in your home because it's a volatile world out there. I talk a lot, Scott. I'm going to cut myself.
Listen, Ted, it's great because what we want to do with, the purpose of these are to be informational. So the more information we can give to people, the better the better educated they'll become. And, obviously the resources that we're going to provide both for you and for me, if they have questions, they have the ability to follow up with us to get even more information.
No.
Which, by the way, you've kind of covered it a little bit. You spoke about the meetups, and then you spoke about what you have on your own website, but maybe if you want to provide a little additional education and educational tools and resources that might be useful for people who are interested in self-directing, that might kind of be somewhat of a template or roadmap for them to utilize. Yeah.
So I think that the sponsor, if there's a sponsor like Spartan Investment Group or another asset class, multifamily, industrial, the core four. If there's a sponsor you're thinking about, they've probably got a YouTube channel. Number one, never be in a hurry to make an investment. In number two, and this is just a life lesson for myself, if a decision feels like it's rushed or it's hard to make, to me, that means that's the wrong decision. Decisions that are easy to make or obvious to me, that's the right decision. Usually for myself, those come with incremental or small adjustments. So I don't like the large, scary bets. I like things that seem like that's obviously the right answer. So now you can gain confidence in a sponsor. Look at their YouTube channel. How much content is on their YouTube channel? Look at a conference like Best Ever Conference. Full disclosure, Spartan is part of the sponsorship group along with Ashcroft Capital of the Best Ever Conference. But, 2 weeks ago, we did a full 1-day event where investors could drop in and listen to various different sponsors talk about, various projects that they're undertaking and best practices at that sponsor. So Scott, back to your question, don't be in a hurry. Number one, don't be in a hurry. Number two, do your own due diligence. Ask a friend. I mean, how underrated is that best practice? Ask somebody who you think has maybe they've dropped comments or they're active with private investments. Ask them, what their worst situation was that the sponsor ever got into that they're invested with, and don't. My suggestion, my best practice is I don't look at the world by way of how much can I make. My first question is, how bad could this get? Because there's some things I'm not willing to take that risk just because I don't want to deal with a bad situation. Anyway, I'll wrap up there.
It's funny, Ted, and hearing you talk, it makes, because we're about the same age, and it makes me think. I know it's more on obviously the traditional markets which we're not really discussing today, but Wall Street is one of my favorite films of all time.
Yeah,
and it has a lot of great lines in it, but one line I just thought of when you were speaking was when Charlie Sheen says to Michael Douglas's character, he's like, "You told me never get emotional about stocks." And I was thinking of that when you said, "Don't be in a hurry," like, because if you feel rushed, like you got to jump right in, maybe it's not the right thing to do. So I thought that was a very good piece of advice.
Yeah.
Ted, you've given me a lot of good information. So I'm glad our viewers are going to have an opportunity to look and digest all this information. Is there anything you want to, you'd like to hear about from me?
Yes. So my observation has been that there's oftentimes, and wrongfully so, there's oftentimes the assumption that the person that's viewing a content or listening to the video or reading an article written by someone in our industry, there's often the misconception that the investor knows what all the fancy terms mean. So let me toss one over the fence at you. But maybe let's just start from the very basic. What is the difference between a self-directed IRA and a 401k plan?
Well, simply put, a self-directed IRA is really no different than an IRA. And you can also self-direct a 401k. The difference between a self-directed IRA and a traditional IRA is the self-directed IRA allows you to invest in what we call alternative assets or non-traditional assets. The 401k, you can self-direct a 401k. Primarily, it's in the solo 401k market, so it's a much smaller group. There's things called an outsourced qualified plan where you can bring a custodian like Next Generation on board as a second custodian, and a portion of that 401k money can get invested in the non-traditional assets, because traditional wirehouses like Vanguard, Fidelity, Schwab, they don't do what we do.
Yeah.
So we're completely different from that aspect. Now, the ability to invest in non-traditional assets has actually been around since 1974. So it's not conceptually new, but it still only makes up, and it's a moving number, but still, I'll say for safety, less than 5% of the IRA universe is invested in the self-directed market. So it's a really small percentage. And, a lot of it is awareness out there. And that's what our job is, to educate and make people aware. And sometimes, because people, like you said, if they're not sure of something, they don't want to go down that road. And for many people, it's potentially a missed opportunity.
Yeah. So now, and let's stay there for a moment, because over the years, some common questions come up, and I want to make sure that I've been answering them correctly. Number one, if somebody leaves their place of employment, and let's go back to that $2 million example. if somebody leaves their employment, do they have, and they want to start looking at private investments? Number one, if they do a rollover, is it taxable? How much time do they have? Can they move only a portion of the account? Maybe speak to those questions.
Well, sure, absolutely. When I used to, like I said in my bio, I used to work in the 401k market. And, when people would leave their company and go to another company, generally, for those who left their 401k, our plan, sort of our strategy to them would be like, you're not there anymore. Why do you want to leave your money where you aren't anymore? Why don't you take it with you? You had mentioned it's portable. 401k is portable. So if you take a 401k and you roll it into an IRA, it's still tax qualified. It's still, as long as it's pre-tax money, it's still tax qualified. So you're not incurring any taxable consequence. The rollover you can do direct between the employer and us as a custodian or any custodian. If you choose to take the funds, you have 60 days. It's called an indirect rollover. So you have 60 days from which to get the funds and then move them to a custodian, or else you'll be assessed a tax, because it would be looked at as a distribution. So the indirect rollover can be potentially dangerous for people who don't know where they want to put the money. But some people use it as a strategy to get the money sooner, because sometimes a custodian and a provider, sometimes there's a lot of red tape that delays the process. And when people want to come on board with us, obviously we want to bring the funds in as soon as possible, because that's going to help them invest more quickly.
And what if somebody just, again, going back to the large 401k plan balance, what if somebody just wants to put their toe in the water? Do they can they leave?
Absolutely.
1 million? Okay. Yeah. So they can leave.
Absolutely. It's called a partial rollover. They could do the same thing with an IRA. If their IRA is at Fidelity, and say they have 500,000 at Fidelity and they want to invest in the private equity markets, they have $100,000 they want to do it with. They can just do a partial transfer, just move over the funds you want to use in the self-directed market. And I guess just to go a step further with that, you're not changing anything, because a traditional IRA with Next Generation is the same as a traditional IRA with Fidelity, Schwab, whomever. So if you come over to us with a traditional IRA, you make your investment in private equity, the investment yields its returns, the investment closes. If you want to move back to traditional investing, that's still an IRA. So there's still no taxable consequence to do so.
Yeah.
And again, part of our role is education. So we make sure every step of the way we're having these touches with our clients to let them know, how everything's going to play out for them.
Yeah. So here's another zinger. You hear this fancy $20 word floating around, and it's prohibited transaction. And there's questionnaires that as investors we have to complete when making a private investment. Put some landscape around what prohibited transactions are and what to watch for there, Scott.
Yeah, well, that's a great question, because that's the one thing that not the main thing, I should say, not the one thing, the main thing we want any investor in a self-directed IRA to avoid is a prohibited transaction. A prohibited transaction is something that is prohibited by the IRS. And when a prohibited transaction occurs, the IRA loses its IRA status, which means the assets would be distributed. Now, a prohibited transaction is when the IRA does business with a disqualified person. There's three types of prohibited transactions. There's a per se prohibited transaction, a self-dealing prohibited transaction, and there's also an extension of credit prohibited transaction. Now, all three of those prohibited transactions, it really doesn't matter which one you do, and we know which one is which, but they're all prohibited transactions. So just to give you an example, a per se prohibited transaction would be like buying a piece of property from a disqualified person. What's a disqualified person? An ascendant, a descendant, someone you do business with, a fiduciary, etc. If you personally guarantee a loan from your IRA, that would be considered an extension of credit. Again, a prohibited transaction. And then the conflict of interest prohibited transaction, also known as self-dealing, is like if a realtor were to buy a piece of property and earn a commission on it. And so it's like you're benefiting from your IRA personally. So those are the things you need to avoid. The actual types of prohibited transactions are what we need to know. What the investor needs to know is just avoid a prohibited transaction. Give us all the information so we can determine if a prohibited transaction may occur, and we can help them avoid it. Because if you kind of engage in a prohibited transaction, then you got to get legal involved, lawyers have to get involved, and it becomes a little messy and it becomes costly. So we want to avoid them at all costs.
And if I heard you correctly early on that topic, the full value of if it is indeed a prohibited transaction, the full value of the IRA is considered to be distributed. Did I hear that correctly?
That's right. And
Okay.
and then obviously if you're under 59 and a half, you're going to be subject to all those penalties, meaning distribution of the asset. If you're younger than 59 and a half, you're going to get a penalty for early distribution. So it's just, it's just complicated because it can go back to when it happened. So if they did, they don't find it the next day. So if they find it like 3 years prior, there's a substantial taxable consequence that may occur.
That water gets pretty dark and pretty deep pretty quick. Better to just be forthcoming and make sure it's an okay transaction, sounds like.
Absolutely. And again, our transaction team is fantastic. They know what to look for. We're well versed as well. So when we're taking on new clients or prospects, we're talking to prospects, we ask the questions to get an idea of where they're going with it. And we'll know usually whether or not, it's going to be a prohibited transaction. So we can either tell them how to make it not a prohibited transaction or just advise them against making the transaction.
Okay. So let's imagine that this is unfamiliar territory. Let's imagine that an investor has a transaction that they're interested in. Maybe a friend has had a long history with a sponsor, and now this friend would like to participate. What is the timeline to the finish line to get something going and make an investment?
That's a great question, because people always want to know how soon can we get this done?
Yeah.
The timeline lasts anywhere from 2 to 6 weeks. We've kind of pushed it back to 3 to 6 weeks. The reason why it takes so long is there's a number of steps that need to be accomplished. The first step is we need to get the application in. The application submitted, it takes usually a day or two to get approved. So that's the quick part. The second stage is getting the account funded. The reason why that's tricky is often you're bringing in either an old 401k provider or it's at another custodian. And that's what's out of our hands. We have no control over how soon that can come. The funds can come over to Next Generation. So it could take, sometimes as little as 3 days, but sometimes as much as 2 weeks. And then the third step is we do a compliance review, 2 to 5 days of the investment. Our compliance team does a really deep dive looking at the operating agreement and all the particulars. And, generally it doesn't take 5 days, but if it's a little more complicated, a transaction, it may. And that step does not occur till the funds come over. So because we go in sequence, the longer it takes for the funds to come over, the longer it takes for the third step to occur. So that's what'll draw out the process. Now, there have been times we've done it in 2 weeks, and that's when all the planets align and everything goes perfectly.
Yeah.
But I try to advise against 2 weeks for most people. 3 weeks is really a fair timeline, and most will be done within 3 weeks. But we can do it as little as 2 weeks. But actually, to a little bit of our previous conversation, if people are coming in rushed, not that it's necessarily a red flag, but sometimes we want to pump the brakes a little to be like, don't be in such a hurry, because we might have to unwind this thing and it's not going to be pretty. Yeah.
Yeah. So shed some light, if you would, on the actual documents, the types of, at Spartan Investment Group, when an investor wants to participate in one of our offerings, what are the documents that are required by the custodian for the investor to engage with the sponsor and actually do business?
Well, we require a private placement memorandum, an operating agreement, which talks about the investment, a certificate of good standing from the fund or the company that's going to be receiving the investment, wire instructions or ACH, how's the money moving back and forth? And then further on, like a buy direction letter, subscription agreement, and things like that. So all that, and the way our office works is, as actually Erica had mentioned it early on, we're basically two teams. We're sales and marketing, and we're transactions. Sales and marketing, myself, Erica, and another colleague, we'll talk to people initially. We'll give them the information. We'll bring them on board. We'll accept and review their applications, and then we'll submit them for review. Once the account is open, we let them know their account is now open. We hand them off to our transaction team. Our transaction team works with them to get the account funded, and then they help execute the investment. And going forward, anything else, whatever type of investment there are, whatever type of documentation they need, our transaction team works with them. And as a team, even though we're two different sides of the seesaw, we work very well together.
Yeah. Makes a lot of sense. Appreciate it.
Yeah. Well, so if you don't have any other questions for me, I think Erica is going to jump back in.
Okay.
There she is. And
Hey, everyone.
and then I guess you could take her from here, Erica. I would say, Ted, thank you so much. You provided a wealth of information to us, and we really appreciate your time this afternoon. I'm wishing you and your family and your company a very happy Thanksgiving.
Thanks so much. It was a real pleasure to be with you, and full transparency. Spartan has a handful of investors with Next Generation, and we've had a good experience with your back office, and so we're very respectful of the service your team affords, and we appreciate that.
Well, thank you very much.
Ted. Obviously, Ted, if anyone needs to get in contact with you, it's nice and big and bold right in your background. But for those viewing, Scott, would you be able to just quickly shout out your contact info so that anyone that needs to contact you directly can do so?
Our office line is 973-533-1880. Again, 973-533-1880. And my direct email is Scott R, SCOTTR, @nextgenerationtrust.com. That's all one word, Scott R @nextgenerationtrust.com.
Thank you. And with that, we'll conclude this webinar, and we hope to see everybody on the next one. Thank you and have a good day.
Thank you, Erica. Thank you again, Ted.
Bye, everybody.